What's going on, everybody? Michael Silva here. It doesn't seem like the stock market really cares about some of the data that's taking place behind the curtain. But we're going to be discussing what that data specifically is, because there's been plenty of times that it matters, and when it does matter, it can happen fast. Yes, if we take a look at the overall market today, we were down on the day, but it was rather flat looking at the S&P 500. Many people are calling this the new bull market. And I posted out on Twitter that people are saying it's a new bull market as if they know what a bull market looks like now with zero DTE options. This is the biggest product. SPX just started trading zero DTE in 2022. So we have a lot to learn in this environment. And this goes the same for bear markets. We don't know exactly what bear markets look like with zero DTE options. I mean, we started in late 2022, and we've seen just massive amounts of volatility and thrashes in both directions. So to see this, to come right back down here and retest these levels, would it be absolutely crazy? No. Would it be crazy is if we skyrocketed up? No, it still wouldn't be that crazy because we don't really quite have a handle on just how powerful these zero DTE options actually are. Now, if we take a look at the 11 sectors that make up the S&P 500 today, we had more defensive. No go figure there, right? Utilities, healthcare, we had consumer staples up there too, and energy. Overall, not the biggest moves, but the big moves came from obviously tech. If you pull up a heat map, you can really see this here, how Tesla was down after reporting earnings, which seemed like good earnings to me, right? But maybe the market front running. It was more of a buy the rumor, sell the news event. 9.74% to the downside. Nvidia down big, Apple down decent, Microsoft down big, Google down big. But everything else up, I mean, it was pretty decent on the day. Healthcare up, industrials up, and so forth. But this makes a lot of sense because we've been seeing these things basically go in a straight line up. So to take some heat eventually would make sense. And it's doing so really here in the middle of July, which matches up with pre-election year seasonality. Now I want to talk about more of the macro stuff, the stuff that's happening behind the curtain. And this has to deal with the Fed and tightening, and this has a big impact on markets. Might not necessarily see it in a few names, but just understand that if we were to have a credit event, you could very well see it translate into the overall markets. And not to say that that's going to be the base case, but we need to be at least aware that the Fed is still tightening. And one of the main things, right, Marty Zweig said, number one is don't fight the tape, and the tape's going up. But then another point that he made, I think it was rule number 6 or something, which is more important than which is less important than rule number 1. But he said, don't fight the Fed, right? The Fed right now is tightening. Okay, so you don't want to fight the tape. You don't want to fight the Fed. So we're at this little bit of perplexity in the markets where the tape is going up, but the Fed is tightening, which in theory we would be fighting the Fed in order to not fight the tape. If that makes sense. Now, if we take a look at the Fed balance sheet, we started tightening. Woohoo. Okay, but then we had the banking quote unquote crisis. They did the bank term funding program. Bam, we came up all the way up here, and now we're starting to get back below those levels. So they're still tightening. And as we know, they're raising rates. And raising rates has a lag effect, right? So it takes about 15 to 18 months from some of the studies that I looked at. But this typically means what? It typically makes people spend less money and encourages savings. And I can show you that here on this chart. If I look at a retail sector ETF, so XRT, just take a look here at XRT and then down here at the Fed funds rate. When the Fed funds rate is high, is it encouraging spending? Well, you can see in the market, it's basically tanked there, right? That happened to be the financial crisis. But what happens when rates slam down to zero? Well, it encourages spending. And if people are spending, that could be typically good for retail. And look at go up, up, and now what happens? Well, they start increasing rates, which discourages spending. And what does the market do? It goes sideways. Okay, well, then all of a sudden we get the market to fall down. Rates go back to zero. And what happens? Market goes straight up. Okay, and it holds to where? Right around here. Do we start raising? Boom, right back down. Pretty cool chart overall. So if you're wondering, hey, when would be a great time to get into retail? Hey, perhaps maybe when these fly back down to zero. That could be a potentially good opportunity as we've seen just throughout history. Now, if we take a look at this chart, this is one that I've been sharing pretty frequently. This is loans and leases. It's basically telling us what? Credit growth is contracting. And every time that we have a contraction, right? Actually, every time we have a recession, prior to that or preceding or into it, we've had a contraction in credit growth, and this is dating back to 1975. You can see the gray shaded areas, and now we're moving into contractionary, right? So we're contracting credit growth, so we're tightening. And you could also look here, if we to break it down, this is for small and large domestically chartered commercial banks, and you can see the percent change on both of these individually are still contracting. We can take a look over here, and we apply the 10-year, 2-year treasury curve to this chart, which is the loans and leases that is contracting currently. And what you'll notice is these kind of like shark kind of jaws that open and close. And what you'll notice here, if you just take a look at the recession, okay, prior to the recession, you typically have these inverted yield curves, okay? Not all the time, but typically every yield curve inversion has led to a recession. Doesn't necessarily mean that it's going to happen, but if history repeats itself, we typically get slowing credit growth, and we get a contraction in the economy, which can very well lead to a recession. And what you'll notice here is when we have the inverted yield curve, you typically have credit growth contract, okay? Credit growth contract, credit growth contract. And then when we get into recession, it's actually when the yield curve starts uninverting and then the jaws close on the credit growth and yield curve. And you could see that boom right here, crossed, well, not necessarily crossed, but it was going up and this was going down, so it was closing the jaws and so forth. And right now, as we stand, we're still deeply inverted while this is coming down. So if we start uninverting and this comes down further, well, I mean, if history repeats itself, that turns into a potential recession, and we don't know what is the main cause of it or what happens during that time. If we take a look over here at net percentage of domestic banks reporting willingness to make consumer installment loans. So are banks willing to do loans? And you can see this is dropping to, well, low levels that we haven't really seen since right here in 2020 during the pandemic. But then prior to that was the great financial crisis. If we take a look over here, this is now looking at the demand for commercial and industrial loans from large and small firms. And you can see that this is actually reaching levels that we haven't seen since the great financial crisis. This is a percent change year over year. So is there stronger demand for commercial and industrial loans right now? No, there's not. And you can see that right here on the chart. Okay, and then you can take a look here. What about tightening standards? Tightening standards for commercial and industrial loans. You can see that tightening standards are also raising as well to levels prior was there to the pandemic when I was getting tightening standards were increasing, and then also back here towards the great financial crisis as well. If we continue on, you can take a look at interest rates on credit cards. Okay, we're ticking up higher here. We're near 21% on interest rates, so that's making it harder for the consumer to obviously pay these back, which I'll show you a chart on that momentarily. If you take a look at auto loan interest rates, we're looking at 48 and 60. The blue is 60 months, 48 is the red, and we're floating right at around 8%, which is levels that we haven't seen since, well, the financial crisis. And we also can take a look at 30-year mortgage rates. Those things are up to, around cycle highs right here, levels that we haven't seen since, 2006, 2007, 2008, all the way back to 2001. And if you take a look here, Bloomberg reported this interesting article about HELOC gaining popularity as mortgage rates rise. You can see that we're starting to see the most HELOC originations since back in 2008. And if you don't know what that is, it's taking basically a credit card out of your mortgage, which is not necessarily a healthy thing in a healthy economy to do. And this report actually said what they were using it for, which I found very interesting. Some were using it to invest in the stock market, which is highly risky. This is just another form of leverage. Some were doing it to pay for kids' schools. It just seemed like, hey, okay, if they're burning it up, what happens if the home prices come down in value? It could get dangerous. And if I take a look here at delinquencies, this is 90-day delinquencies reported by the New York Fed. You can see here that credit card serious delinquencies, 90 plus days. So, it's not just like they forgot a month, it's 90 days. Credit cards are reaching up levels that we haven't seen for a little while over here. But then also, if you take a look at auto loans, these things are rising up to levels that we haven't really, it's creeping up into the 2008, 2009 territory there. And this is all on the back of the student loan payments, you can see the big decline here. We haven't really started paying those back yet, but it'd be likely if these start having to be paid back that we might start to see these increase even further. Okay, so that's behind the scene from more of a macro perspective. And what it means to me, it means this. It means that banks are tightening, right? Credit standards are tightening. The Fed is tightening. Interest rates are high, but no one seems to really care yet. Okay, so what happens when people start caring? Well, it could be a dramatic impact to the overall markets. Things can take a change very quickly. And that's why we have to always be prepared for a potential recession. Doesn't mean that the markets are going to crash, this or that's going to happen. But if you can get your economic house in order, that's why we give you this data. That's why I give you the data and share with you what it is that I'm looking at. Now, if we take a look now at the S&P 500, we came in a little bit where, well, we're still within the weekly expected move. We got outside of it. This little candle pattern right here, it's a 3-bar reversal candle known as an evening star. You get an authoritative candle. Let me redo this. Authoritative candle to the upside. You have a small body, which we discussed yesterday, which means it's more indecision. And then we had follow through a bearish candle down to the downside. So this right here is a 3-bar reversal pattern, but you need confirmation. You need to get below the low of this day, get below the low of this. And if that does take place where we see the lows crossed and broken, it opens the door back down to this quarter to date anchored VWAP. So that would be the level to watch there overall. But honestly, nothing that broke this uptrend. The uptrend is still intact. However, on the shorter term, we need to be a little bit cautious, right? We did break downside of the daily expected move today. Now we updated them. The daily expected move is right near the upper weekly expected move. The lower daily expected move is at 449.48. We still have an inclining 5-day moving average. Price closed below it, and it closed below the week-to-date anchored VWAP. So what I like to do is anchor a VWAP to this prior swing high and see if price can get back above this level. Obviously, we have one more trading day left of the week. So if we get back above, just pay attention to see what price does in these areas and see if it can get back above this anchored VWAP to open the door to come tag the upper weekly expected move. Now, if these act as levels of resistance, you want to pay attention to see if the 5-day moving average starts to flatten out to start curling back over. All right, these things got kind of extended to the downside to see a reflexive bounce. Boom is always possible, but just make sure that you're watching for a series of lower lows and lower highs breaking down if you are going to get more bearish where, the 5-day moving average starts rolling back over. But as it stands, yeah, short term we broke, so you just requires more cautiousness here, but it's not like it's crazy broken yet, right? So if we start getting back above it, test the week-to-date anchor VWAP, then test this one to open the door back up to here. That's what I'd be looking at. Now the Qs, this one got a little bit more dramatic, right? If we're looking at the daily time frame, also a 3-bar reversal, and it's a heavy reversal right here as this candle really got just destroyed to the downside. It's typical to see reflexive bounces, but remember, we're still within the weekly expected move. We got outside of it. We talked about the monthly expected move. We came back inside of it. Okay, but where are we? We're coming right down to the quarter to date anchored VWAP. So if I bring up a 15-minute chart, I would say the lower daily is right by the lower weekly. So if we get down into these areas, that would fill that gap right over here. And these areas could potentially act as levels of support, right? This is just taking a breather so far, right? We got to see price action base out and see a series of, for example, if we just crack down tomorrow, people are scared, oh, the world's ending. Well, what if we start doing something like this where we build up, a low, a higher low, and when we buy the strength, and then maybe a back test, and then so forth, and starts working itself back up to the 5-day moving average. That's a possibility. Now, on the flip side of that, if it's going to continue to be bearish, remember, it's very hard to trade bear markets or from the short side, but if this starts flattening out to rolling over, price action could come all the way back up here tomorrow. Say we get a VIX crush Friday, and people are like, it's back to normal. Okay, but what if the 5-day moving average holds its resistance, and then we start to short into weakness when we see those lower highs, and then we break down the lower low, and then you have a stop, and then you trail down as the 5-day moving average goes. Okay, so not that many type of trade setups right now in the midst of all this volatility. However, I can see that if you drop into time frames, you can watch these key levels and how price action interacts with all of them. As it stands right now, if I look at the RSI and we're coming into a quarter date anchored VWAP, I would love to see price take a quick hit down here, because if it gets further extended, I feel like people that, could be a little capitulation, people can flush out, and you start to look for a long position here to maybe come back up to retest the quarter to date anchored VWAP. Okay, boom, boom. If we crack down through it, potentially comes back up and either breaks up through, or we start cracking back down. But that would be one thing that I'd be looking for. Or if price comes down and tests it and we do a U-turn, right? So the quarter date's here, price flushes through it. We've seen that, but it's still an inclining quarter to date anchored VWAP. So if price comes back up, maybe acts as resistance, then it breaks down further, or we start to see it build strength and we start to pop right back up through to come retest the 5-day moving average. And that could be a trade up into that level as well. So there's going to be a lot of different paths you can potentially look at. But the main key here is when you're trading is, if you try to catch the bottom, it could just be a series of another lower high. So that's why I like to wait. If you're trying to catch something, I would like to see a lower high and then eventually take out the prior swing high. We take out at a higher low, then take out the swing high, and so forth to make a catch. So you're basically, instead of buying the dip, you're buying some strength thereafter. Now, also, what took place today? Well, we saw a stronger dollar. That probably helped to the point of seeing some of these assets come off. Also, the rising 10-year yield probably helped knock back tech a little bit. This is a little interesting to me. As we broke out, we came back in, and now it's holding as support. So if that's the case and this thing starts taking back off again, oh boy, buckle up, right? As we seen the TLT, we saw this big move and we talked about, I feel like it's still sniffing out a recession here, but we saw it back off a little bit today. So we'll see if it can reclaim these moving averages in the near future. Bond market volatility still is rather elevated here. So these big swings back and forth makes it very hard to trade bonds. So just be aware of that. The last chart I'll get off of here with is the CPC. I haven't showed this one for a while. It's a sell signal when we cross down beneath the red line and cross back up through it. The last time that this has actually happened was actually in late December right here, and that marked the start of the bear market. It actually was the same thing prior to the COVID crash as well. It marked the top there. It doesn't necessarily mean it's always going to be that dramatic. Now, the buy signals are when it crosses back down through the green line, back down through the green line, and sometimes it offers up multi-day pops to, sometimes longer, sometimes shorter, and so forth. But when we got those buy signals, that helped out a lot. The last buy signal was right here, and that was right in this area where we saw pop, and then we saw it move a little bit higher. So just be aware that this chart is not updated. The data comes in later tonight, so this might move down a little bit more, but I don't know where the CPC is after a day like today yet. That's all I got for you guys on today's episode. If you haven't checked the pinned comments down below and want to get access to the swing trader community, make sure to check that out. I also have the IBKR link there too as well to check out, which there's a campus button there, which gives a lot of good courses, webinars, stuff like that. This is the program that I'm moving all my stuff over to and trading on personally. All right, that's it. See you later.